Hello, and welcome to the Options Hour. You're listening to TFNN, and this is Victor Jones. For the next hour, we're going to be talking everything options. That's options, stock options, futures options, everything out there. And it's a very interesting start, obviously, to the year here. The S&P 500 trading 1275 and a quarter, up 22 and 3/4. The Dow at 12,376, up 226 points. So, almost immediately the futures this morning were up $20, and into the open we rallied as high as up 26. So about four points higher, close to 1280 earlier this morning. And the question is kind of what's fueling, I think, the rally here, and overall, I think you're actually seeing a lot of the metals, a lot of the mining is actually outperforming the rest of the market. And interestingly enough, in the European market overnight, that was the case as well. A lot of the mining companies, the UK miners, were leading in the overnight market in Europe. So if we're kind of taking a look here at, we'll do a quick market wrap before we jump into all the calls. As always, you're more than welcome to give us a call, 877-927-6648. We started a new year. We've got about 17 days left to January expiration, so obviously still some time to put on some positions here, and also, we've level shifted just a bit. So some people, you might have some positions here that you're caught in. You're thinking about potentially rolling up or rolling out. So give us a call and let's talk about those options. 877-927-6648. Taking a look at the S&P 500 here, we'll just look at the SPYs. We're trading at 127.97, and we've been saying over the last 3 months that obviously we've been trading in a pretty tight range, and that range up until now has really been 1265 on the upside and 1200 on the downside, with probably 25 points either direction. On the downside, we overextended last expiration to about 1175 2 expirations ago. We extended on the upside to about 129.32. So even though we've broken it out of that range over the last 2 months, still a little bit of upside resistance there at that 129 or 1300 level in the S&P 500. If you remember, over Thanksgiving, or right before Thanksgiving, rather, the call was, that we'd have a sharp kind of sell-off, if you will, to the 1200 level, right when we were sitting around 1265, and rally up to the 1300 at the end of the year. Well, the market overextended to the downside to 1175 and rallied, but didn't make 1300 by the end of the year. We were about 3 days late, but still, interestingly enough, kind of what the thinking or the psychology behind the market movement over the last 3 months has actually been dead on. Really, really light volume here. Actually, today, in terms of volume, you're actually almost equivalent to the market volume on last Friday. So interestingly enough, even though we have light volume, we're surpassing what was the lowest day in terms of trading over the last year, which was last Friday. Trading again 127.94 as the VIX update. We're at 22.78, down 62 cents. Not much movement in the VIX. I think we opened up. The first tick was down about 42 cents. So we've moved down 20 cents since the opening tick in the VIX. Again, 22.78. The /DX, that's the dollar index, the dollar weighted against a basket of the world securities trading, world's currencies, trading 79.93, down 59 cents. That's about 0.75% on the day. Gold, 1605.20, up $38.20. So interesting kind of convergence here, where you're seeing gold moving to the upside at the same time you're seeing the securities market moving to the upside as well. So you've actually, we broke that 1600 level, and we continue to say that 1600 level would be kind of an interesting support area. While there was a short-term break over about 3 trading sessions, again, the market has rallied here $38 to trade above that level. Crude at 102.50, that's up $3.66 on the day. That's 3.75% on the day. So crude oil again has rallied past that $100 mark. So we were playing right at the $100 level, kind of 101.5 before breaking over the last two trading sessions and failing at 100 both sessions. And today you're seeing a little bit of conviction here with a strong move. Again, 102.50 up 365. And if you're looking at whether or not you're trading crude via the ETF or you're trading the futures contract, interestingly enough, if you look at the actual ETF, that's USO, at 39.48, that's up $1.37. We've been watching the options market here in terms of USO and in terms of crude. Essentially, you have about almost 2 1/3 times more options trading than over the last 5 days. Now, you have to take that with a grain of salt. Obviously, there was a pretty low, you tend to see low volume into the end of the year. And again, last Friday was the lowest volume trading day of the year. But again, you are seeing a little bit more increased call activity than you are on the put side. So about 1 1/4 times more puts trading today. So just a little bit, about 25% more than average. And on the call side of USO, you're actually seeing 3 times as many calls trading than what was traded over the last 5 days. So we'll look at some opportunities there. We'll actually look at what strikes that volume's taking place on. But it's very interesting here as we're breaking 100 with a little bit of conviction, a little bit of downside break in the dollar here. Again, we're in the DX. DX, we're over the 80 level, if you remember the last time we spoke. So since then, we've had about a 3 trading session break from the 81 level down to 79.94. We'll take a look at a couple of interesting securities, I think, before we go into a few more commodities and kind of high flyers and low flyers, so to speak, for the day. We want to take a look at McDonald's. So obviously, this is something that we've brought up, I think, just a few times over the last couple of weeks in the show. McDonald's traded at a high, 52-week high at 101.59 today before breaking, and really it opened on the high and really has not let up since the opening tick, and we traded down as low as 98.88 on today's session, and we've rallied just a bit, maybe 50 cents in the last 10 minutes or so. So I think some interesting action here. Again, you're seeing a very, very strong move to the downside, down about a percent or so, right around that $100 level. And it was an interesting article over the weekend. I believe it was in the Wall Street Journal. It said at $100 per, which would you rather buy, oil or McDonald's? And here, you're actually seeing obviously it was kind of half said jokingly, but interestingly enough, you're seeing a little bit of a break in McDonald's here. Again, 99.41 down about 1%. Crude, again, is up about 3 2/3%. Again, feel free to give us a call, 877-927-6648, in talking about, I think, the markets here. Talking about McDonald's, we'll go into a few underlying securities here on the day, but we just want to talk, again, shortly, because I think we positioned, or we put on some interesting positions, or talked about putting on some interesting positions and playing this range-bound market. And I think there might be some people out there that, if you potentially took some opportunities, or you took an opportunity to take advantage of that range, and you're seeing a sharp move to the upside, if you are positioned short, either with short verticals or anything else, we want to talk about, how you can potentially look at adjusting those positions if, in fact, that level shift is changing, I think, your outlook on your position. So I'll just bring up a few things here. I believe in last Tuesday's show, we were talking SPY. We're right around, or fastly approaching, I should say, the 1265 area in the S&P. We're now at 127.85 in terms of the spiders. And when we looked initially, we had a 130, 131, just a very simple short vertical spread. The 130, 131 call spread, I believe, was trading right around 25 cents. So you could get, you put up, you're risking 3 to make 1 in that scenario on a one wide spread. Here, again, vol has been sucked out just a little bit. If you look at, selling it, you're actually selling it at 36 cents. So it's trading 10 cents, 11 cents higher than it actually was the last time we spoke. And obviously the reason is we're trading closer to that 130 strike, and so both those options are worth a little bit more money. So there's a couple of things that you can do. I mean, here, obviously, if we're thinking, the market is positioning itself for a little bit of a pullback at the 130 or the 1300 level in the S&P 500, clearly you can look at just diversifying the same position, right? You're diversifying at different entry prices. You put on, let's say, a couple lots at 25 cents. You put on another couple lots at 35 cents, and you have a break even at about 30 cents. So you're in. And you're diversifying actually the entry price. Obviously, that's always something you have available to you. If we're looking at a probability standpoint, if we're keeping the deltas consistent or the probabilities consistent of what you're putting on, interestingly enough, because we're a week, basically, a week has passed since we initially talked about that first position, it changes the delta somewhat because we're closer to expiration. So interestingly enough, the 130, 131 call spread still has a 32% chance of expiring in the money, which essentially means a 68% chance of expiring out of the money. So from a delta standpoint, if you're trying to remain consistent there, that's, you still have that opportunity, and that's the reason there is the initial time we put this on, or we looked at putting it on, there was 24 days to expiration, whereas you have 17 now. There's less time for that price distribution to occur, and therefore you still have similar probabilities, and you even have, a higher kind of payout in terms of what you'll actually receive. Quickly, I'll talk about, how you can potentially adjust those positions. So let's say you are short either at that strike, maybe 126, 127, 128, where you got a little bit more aggressive here. How can you potentially look at rolling or adjusting those different positions? So I'll quickly look at what happens if we buy the 131 butterfly here. And we're going to price this out. So buying the 131 butterfly, let's look at what you're essentially doing. You're buying the 130, you're selling 2 of the 131s, and you're buying a 132 behind it. You're doing that at 8 cents. So essentially what you're doing is you're potentially paying 7 or 8 cents, and you're rolling your strikes up. So if you sold that for 25 cents or 30, let's say you sold it for 30 cents, you'd be now paying, let's call it 8 cents at a debit to purchase that butterfly. And you would now be in a 131, 132 vertical spread at about 22 cents of value. And if you look at the 131, 132 today, if we were to sell that vertical, it's trading 26 cents. You'd actually be shaving off maybe 4 to 5 cents of what that value would be, the total market value today, and you'd be doing that to get a little bit more comfort with your strikes. And this can, obviously, this example, it's, you can utilize it anywhere, not just in this spider market. Obviously, it works in other markets as well. It's a little bit more difficult when you start looking at securities that aren't penny priced or something that you don't have as much liquidity. In that case, when you're looking at executing a butterfly, you might have to give up a little bit more edge. In this case, again, if you're following along here, we're short the 130, 131 call spread, and we put that on at, let's say, 25 cents. If we were to roll using a butterfly with a 131 butterfly, so it's a 130, 131, 132 butterfly, you would essentially be making that roll at 8 cents. So from 25 cents, we would take off 8 cents there, and you'd basically be in the butterfly at about 17 cents, let's call it, at a true market value of 24 cents. So that's just, one way you can adjust these positions. Obviously, in a day like today, if you got caught on the short side, there's different capabilities for you. One is to look at rolling out to the next month. You've still got 17 days. So if the opportunity exists, or if there's enough credit in the position that you have on, obviously you can always price out those butterflies if you're in a short vertical spread to see exactly what your ending credit would be and whether or not that makes sense for you. And I always say, I think, whether or not it makes sense is if today, would you put that position on? Would you sell this 1 point wide vertical spread for under 20 cents, for 18 cents, 17 cents, whatever you could execute it at? And if the answer is no, then obviously you should potentially look at rolling out to that next month or closing out the position altogether if you truly are nervous about that short end of the strike. But if the answer is yes, this is a risk-reward scenario that I've taken or I've introduced in the past, then obviously it's something worth looking at in terms of rolling up those strikes in a vertical call spread. Again, as a market update here, we're trading 1275.50, up $23 in the S&P 500. Silver is trading 29.51.5, up $1.60. And silver SLV 2870 up $1.76, and the Dow here 12,374 up 224 points on the day. So we'll take a quick look at the S&P 500 and some of these securities that are performing well, and some that some that aren't quite performing so well on a day like today. So we'll quickly bring up. And if you're using the ThinkorSwim software, you can just simply go to Market Watch, the Watch tab, select a public watch list. I'm going to look at the S&P 500 here, and we can quickly look, and you can see some of these securities that I mentioned earlier. ANR, Alpha Natural Resources, trading 2207 up $1.64. That's 8% move to the upside. BTU, Peabody Energy, 3608 up 8, close to 9% on the day, actually. We're going to talk about a few financials here as well. Let's take another look. I believe here's another one. Cleveland Cliffs, CLF, 65.68 up 5.33% today. So here, ANR, BTU, and CLF. And we'll just quickly add them here. We'll add them here. We'll just keep an eye on our sizzle index, our put and call index indices as well. So essentially, if you're utilizing the ThinkorSwim software, you have the ability to keep your eye on the options activity. I mean, if something's trading with a sizzle index of close to 1, that essentially means it's very similar or the same options volume as the last 5 days. So essentially, it's a ratio of today's volume over the last 5 days. If you're seeing something, let's say, with 2, 3, 4, 5, something with an index of 4, for instance, means 4 times the normal option volume or the 5-day option volume is traded today. And so from that, we also have this put sizzle and call sizzle index where you can understand, hey, is there more volume taking place on the call side or put side versus its average? And here, interestingly enough, again in BTU, you see about close to 5 times the option volume being traded on the call side versus 4 times the option volume being traded on the put side. As I promised earlier, let's jump into a few of these. Let's start with oil. I think that's, obviously that's where we want to start before we jump into the natural resources here. Again, as an update, and we looked at this before, but from a charting perspective, that 39 level basically matched up with $100 in crude. So USO is the ETF that tracks crude oil, and again, the 39 levels has been basically reflective of $100 in the crude futures contract. And today, we've made a move to 39.50 on the upside and a strong gap from $38. If you look essentially at where this volume is taking place, take a look here. You're seeing a lot of activity on the call side in February at that 42 strike. So about half of the, not even, maybe, a quarter of that volume is paired up, or close to the same volume as what you're seeing in the 41. So potentially some 41, 42 call spreads being placed there. And on the same token, the 39, 38 puts in February as well. About half of those could be paired up as put spreads, and the rest of those potentially outright. So you're seeing, again, that volume is taking place a couple strikes out on the call side versus the put side, which is concentrated right at the money. Again, if you go out to March, you're seeing a lot of that activity there at the 42 strike again. So the March and the February 42 strike are having extreme amount of volume again versus the last 5-day average. We'll take a quick look here at SCO. I think Mitch in Boston mentioned SCO in the chat here, so we'll go ahead and pull that up. ProShares ultra short crude, so obviously very similar to USO, but it's double leverage and it's an inverse. So obviously if crude oil is doing well, the ultra short's going to move to the downside. 35.79, down 7.5% on the day, $2.90. SCO is kind of interesting, I think, in terms of volume here. USO's traded 6 million shares up until today. SCO's only traded 1.2 million. So if you actually look at the volume here in terms of the options, you're not seeing much action at all. I mean, maybe 55 contracts to 200 contracts at any one strike would be an extreme number of volume versus, 1, 2, 3, up to 6 to 8,000 on USO. So I think if you're looking for a crude play, obviously USO is going to, from an ETF perspective, USO is going to have the most liquidity. But SCO obviously gives you the opportunity to trade the outright. But from a bearish perspective, you're looking at USO and you're looking at let's say an option play on crude, a bearish option play on crude here at the 103. Well, in that case, if we were to look, let's just say at a probability standpoint here, we'll always got to pull up probability of expiring. And you see that 36 strike on the downside has about 32% chance of expiring. If we were bullish, so let's say we're long SCO, which it appears Mitch from Boston, he's rooting for a downside move in SCO. Let's say we're bullish then in USO, which is a positive relationship to crude versus the inverse relationship. If we were to sell that vertical spread here at 24 cents, we basically have a 75% chance of success there at the 36-35 vertical call spread. You're going to take in about 24 to 25 cents depending on how you work for execution there. But in doing so, obviously you have volatility here of only 40% versus SCO where you have implied volatility, which is double, which makes sense, about 70% in terms of implied volatility. What this means is you actually get a bit further away from the money. In this case, we're at the money of $36. We could go out and sell the 31.30 versus the 36.35 in USO. So basically, you're $3 away from the money there. In this case, we're about $7. So it's, again, makes sense, right? But here's the difference. At 31 to 30, your spread, 25 cents is the actual mid price or what this is worth. So again, you're seeing 1 point wide spread. I could take in 25 cents here. Look at the natural. The natural on this is actually at even. So if we were to sell the 31 spread, the 31 put at the market, you'd bring in $1 to do that. If you were to buy the 30 behind it, you'd pay $1 to do that. So you can see there's a very, very large spread, about 50-cent spread there in terms of executing that underlying security, which is again why it's difficult as an options trader to try and look for those opportunities in anything with really low volume. SCO here for an ETF at 1.5 million on the day isn't so bad. The options market though is not great. We'll take a look here. We've looked at McDonald's. I think we want to take a quick look at Apple, of course, before we do another quick market wrap-up. Apple trading 410.89. We are up about 1.5%, up $6 on the day. So I think what's interesting here, and what continues to be interesting, is that 400 level in Apple. So you've got the 400 level in Apple, and on the upside you've got about 425, which tends to be that upside resistance. When I say tends to be, if you look back in September expiration, in August expiration, well, basically, no, let's call it twice in September expiration, we ran up and hit that 425, 426 number. So you can see there's obviously sellers there, and buyers are reluctant, at least in the past, to take us past that number. If we look, however, at the options market, let's just look at the Jan 12 options. From a probability standpoint on the upside, 420 is actually our kind of our standard deviation move to the upside. So it's actually not even as high as 425. The options market's pricing it in just a little bit lower here at 420. It's really in the middle between 420 and 425, maybe 422.5. And on the downside, the probabilistic move is basically in between 400 and 395. So let's call it 397.5. So you've got this range basically of about $13 to one side or the other, $12 to $13 on one side or the other of what that expected move is. And from a trading perspective and just watching Apple, there's potentially two different ways to play this. Obviously, there's the potential to put on an iron condor here. Techs tend to be seasonally weak, going into this part of the year. So I think you might have a little bit of downside pressure, but at the same time, you have earnings at the end of this expiration cycle. So you do have earnings at the end of this expiration cycle. In addition, you have Apple, who's looking to release their iPad 3 at the end of the first quarter. So I think that's from a trading perspective, it's difficult and always has been to take these to take a bearish stance in Apple going into a product launch. However, and especially into earnings. However, I think you've got you have an interesting time here in terms of February. You have a lot of these tablet statistics numbers coming out, the new market share numbers, and with the holidays, with all these discounted tablets available, it'll be kind of interesting to see how Apple holds on to that market share. From a trading perspective, there's a couple of things that we can do here. Now, Apple's trading with about 31.5% implied volatility. And in the back month, they're trading with about 33.5% implied volatility. So 31.5 in the front month, 33.5 in the back month, and I think what that essentially means is that their earnings must come on the 17th after the market close, which is on expiration. So actually, what's going to happen here is Apple's going to release their earnings on expiration day after the close. So if you're putting on these positions in January, while you'll see, a lot of the implied volatility is actually, this is kind of an interesting situation here because you have a security which does not technically expire until the Saturday, and you have an underlying, right? You have Apple, which could definitely move after the close, so they'll release earnings after the close. You've got an extended hour session, and so you've got kind of an interesting situation gearing up here, where you'll need to be careful in terms of expiration. To the upside, selling the 420, 425 call spread. If we go ahead and take a look at that opportunity for someone who is bearish going into the end of this expiration cycle, selling at about $1.62 on 5 wise. So basically, you've got $3.40 of risk there. So basically, you're putting on 1, and you're risking, for every 2 you're risking, you're looking to gain 1 here. So it's an interesting kind of risk to reward scenario on the upside, 420 to 425, and you've got that same opportunity there on the downside. So you have both a bearish and a bullish play here at 405. Let's call it 400 to 395 put spread on the downside if you were actually bullish going into these earnings. So again, that would position you right around that 400 number. I think, it's here going into any type of release, whether or not that 400 number is actually going to hold as a strong support number. Again, if Apple comes out and says, hey, we're expecting a shift in market capitalization here, not market capitalization, market share, I think it could be interesting. And what will happen here is as we see support here at that 400 level, just looking at what G7 is posting in the Tiger Den here. So they haven't confirmed it, and yep, you're absolutely right, G7. They haven't confirmed it. It's an unconfirmed date that we have from our market data vendor at 117, but you're right. They're very seldom, if ever. I don't remember a time that they released on a Friday, so we'll keep an eye on that, but it is unconfirmed at this time. Quick market wrap here as we wrap up a half an hour. 1273.75 up 21 1/4, so we sold off just a few dollars or so. We sold off just a few dollars. The Dow, 12,351 up $201, so down about $27 since we first started talking. The IWM, the Russell, 750 up about $11.50, and the Qs, 56.88 up $1.05. The VIX, 22.82 down 58 cents. Again, right around where we last quoted it. The dollar. Let's take a moment to talk just a little bit about the dollar before we jump back into gold here. So we'll look at actually a few securities that actually are optionable here. in terms of UUP. UUP is PowerShares U.S. dollar bullish index fund trading 2227. 2260 is basically the resistance area that has been set over the last, maybe 3 months or so, which makes sense because you're seeing not only that resistance area there, but you're seeing a little bit of support area in the Euro USD, and you're also seeing in terms of the dollar index, you're also seeing a resistance level being made there at about $80. Again, UUP here, if we look at the volume, traded about 7.2 million shares today, a little bit more volume here, a little bit more volume in the options market as well. The at-the-money is traded about 2,600 contracts. I think the difficulty here is the increments. In terms of UUP, if you look at the range, you look at the volatility, it tends to be around 12 to 15%. Here we're trading close to the 15% range. On the low side, maybe trading as low as 12%, and that might have been about 2 months ago, 2 to 3 months ago. So if we look at, again, the opportunity here on an upside, basically if we're bearish here, we could sell the 22-23 call spread at about 30 cents mid. So if we look at this, get pretty close to about 30 cents on the upside. So you're risking 70 cents. You're taking in 30 cents in terms of credit. Taking a look here, a little bit of break in the S&P. We're going to keep an eye on our S&P down 1273 half, 1273 half. So we'll keep an eye on it here. And we'll keep an eye on the miners as well. But again, 22-23 in UUP, if in fact you're looking for a little bit of a break in the dollar here. So you've seen a sharp move in crude. You've seen a sharp move in gold, and you've seen the dollar over the last 3 sessions start to give up some of its gains. So now you have gold sitting at its 1600 level support. You also have crude breaking with a little bit of strength past 100. So I think the opportunity here, if you are potentially, let's say, if you're long gold or you're long crude, obviously as a hedge, you could obviously go long the dollar. If you're looking for a similar play to either one of those things, and you there's a correlation here. As the dollar becomes a little bit more expensive, you would expect the commodities to become a little bit cheaper. But you kind of have to be careful because at the end of last year, you actually saw a couple of things happening. You saw crude getting more expensive and making this move up to 100, and now that it's broken just a bit. At the same time, you saw the dollar get a little bit more expensive. You saw the dollar, or the DX, the dollar index, trading as high as $81. So, you have to be a little bit careful, and obviously there are certain periods of time where that correlation doesn't hold day for day. But interestingly enough, there is the opportunity if, in fact, you think commodities are getting a little bit expensive here, or you think 1600 and 100 are basically those resistance areas in both those commodities. You'll see a little bit of a turnaround, but don't necessarily want to play them. The inverse play or a somewhat correlated play is to obviously sell some call spreads in the dollar here, in particular UUP. Take a quick look at Google and Amazon here. Google, ticker symbol GOOG, trading 659.73 right now, up 2%, very close. It's actually outperforming the rest of the market by about 0.75%. Made a high today at 661.79. 661.79 before peeling off just a little bit, about $2.50 from the high. And here at 650, I mean, essentially you saw a little bit of resistance in Google here at 625 before breaking to the upside. If you look back, I think we have to go a couple years back here. Should see resistance right around 670 or so in the past, but you're actually seeing that high. Let's head back. Yep, 750 back back on November 7th of 2007. Again, November 7th of 2007, we made a high of about 747.24. We're now about $100 cheaper, 659.21. We'll take a look at implied volatility here. Implied volatility in Google relative to the rest of the market is about 30, and I'm looking at, obviously, not the weeklies, I'm looking at the Jan expiration, 37%. Overall market's about 22% in terms of implied volatility, so a little bit more expensive in terms of the underlying security versus the overall market. Google up $13.71 on the day, 659.51 at 659.71, 20-cent spread in terms of the market itself. But essentially what you're seeing in Google, if you look at that volatility at 37.2% for January, what that essentially tells you that the options are priced in such a way that you might expect about a $44 move in either direction. Or at least that's what the expected range is. So no more than, let's say, $44 on the upside or $44 to the downside. So we're trading right now at let's call it 660. You would expect a range on the downside of 620 and on the upside of 700. And if you look, a lot of the probabilities here, you should see something that correlates strongly. And again, that's, you would expect to see that about 32% of the time. So essentially 68% of the time you would expect to be trading inside of a range of $43.50 to the up or downside. So if we look at the 700 strike on the upside, it's trading, about, say, that whole spread as a whole is about $1.10. So essentially you're risking 4 to make 1. So every 4 you're risking there, you're putting on to make 1. You're seeing a bit of a break. I'll take a quick minute here. You're seeing a bit of a break here at 1272.25, up 1975 in the E-mini. We'll go ahead and keep an eye on it here. We've been trending down for the last couple of minutes here, so I want to make sure we keep our eyes on it. A little bit of a break. Again, traded up as high as $26 to the upside, basically $12.79, close to $12.80, and we're breaking down right around $12.72 right now. We'll keep our eyes on it here. But again, we'll take a look at Google, and I think whenever you're looking at something, at least from my perspective, you look at something, and maybe you guys have noticed it here. At least when I tend to look at some of these different securities, and I see these things at kind of their high side of the range, I think from a certain perspective, you start to think, even if we go higher here, if I'm just playing odds here, even if we go higher and this is the upside of the range, what is the opportunity to potentially go short for a small pullback? Even, it could be large, and obviously the old saying is, the market likes to walk up the stairs and fall off the cliff. And, if we start to play to that upside of the range, and even if the overall trend is to the upside, but we get a nice pullback, I think that presents some interesting opportunities here. So I think when you see these different securities that are trading at the highs or trading at their high side of the range, and you notice that some of the trades I think that we might talk about are maybe they're bearish in those cases, or we're at the bottom side of the range that tend to be bullish. The reason for that is, if you're seeing a bit of a range-bound market, there's two ways to potentially play that. Wait till you're in the middle of range and put on some sort of neutral strategy, such as a calendar, such as an iron condor, double diagonals, and anything else. Or you can get a little bit more aggressive and sell on the opposite side of those ranges. So whether or not you're constructing an iron condor, and I'll talk exactly, we'll walk through that because I think the market has been so range bound. It'll be interesting to know how we can potentially leg into what's called an iron condor. So let's go into that right now. I'll ask anyone in the Tiger Den, go ahead and type in an underlying security. If you feel some underlying security has been a bit range bound, go ahead and type it in here. In the meantime, I'll just use the spiders. If I get some securities typed in the Tiger Den, we'll go ahead and use those as well. So we'll just give a for instance here. And I think the spiders are an interesting example. You can see if you're watching on the telecast here, we've drawn a Fibonacci retracement from the low, which was made in mid-September at 107.5, to the high, which was made basically right after that expiration into the beginning part of October at 129.32. So, from that move there, you've basically got on a 38% retracement, that puts you right at 120.88, which is the range that we've seen back and forth. We'll go ahead and take a quick call from Gary in Colorado, who's got a question on spreads. Gary, are you with us?
Hello.
Hey, Gary, how you doing?
Very good. How are you this morning?
Good. Thanks for the call.
I've got kind of a general question on spreads. I was, and I'll just give you one for example. I was looking at a vertical on SLV, selling, in this case, the put, not a call spread. The put spread, selling the 33 and buying the 28.
Selling the 33, buying the 28. Okay.
And this is just an example. And my general question is, why not the wider spreads instead of narrower $1 spreads?
Yep.
And that's sort of my general question, whether it's a put when you're selling premium, whether it's a put or a call.
Okay. Yeah, and the only, you actually bring up a really good point, and I'll go through that here. I wanted to ask you really quickly, Gary. You've looked at this spread, which is selling, and I want to make sure I have this right. We're in January, correct?
Right.
Okay. Selling the 33 put and buying the 28 put behind it. Is that right?
Yes.
So essentially, you've got, you'd put up, let's call it $1.20 to do that. $1.30 maybe, right, in capital, and it's a very bullish spread, obviously, because your short strike is 33, so you're essentially expecting an upside move on expiration. Obviously, you'd have to be at 33 or more to expire, in the money in terms of that spread.
Right.
Right. So you're also putting up $1.80, which essentially means your break even is about $29.80. So your upside expectation is $29.80 or greater. So I'm curious why you're going so far deep in the money to sell that spread.
Well, I'm doing it as an example more than I believe that silver's going to do that.
Gotcha. Okay, so here's why I always, when I'm tending to give these examples, Gary, I always do the one wide spread just to keep it very simple. I think there's a lot of people out there, if this is their first time listening, we always want to encourage, obviously, if you're just getting started with options, you want to keep it as small as possible. Maybe the first couple things you put on are maybe just simple one lot. So I'll give you an example. If let's say I was trading SLV here, and I was bullish. Well, let's just look from a probability standpoint. Maybe I would sell the 27.26. It's just a 1 point wide spread. It's worth. Let's go a little bit closer. Let's go 28.27. So I'm selling 28.27. It's worth 30 cents. Well, the only reason I always use, or I tend to use the 1 point wide spread for an example is just because it's easy math. When you look at a vertical spread or selling a vertical spread, you can always get your probabilities of success directly from what that spread costs you or what you'll take in. So basically it's 1 point wide. So that essentially means you'll take in 30 cents, which means you have 70 cents of risk on the table, because that's the difference between the credit you receive and the width between the strikes. So 70 cents, which is your risk, over the width of the strikes, is your percentage of success, which is 70%. So there's two things from this that I actually like to talk about, Gary, and I'm glad you brought it up. If I were doing, let's say, if I'm doing a one lot, clearly the 28.27, that might be great. Let's say I'm putting on, 5 contracts, 10 contracts, 20 contracts, whatever it would be. What I tend to do is actually price out my probabilities, or basically the edge here. So I know I could do this spread if I'm doing 10 contracts. I know I could do this 10 times, right?
Right.
I could do this 10 times, and I'm going to bring in a credit, let's say, of $300. Or I could do the 28-26, so I can go too wide. I could do that 5 times, right? Because essentially, if you look at the difference, in this case, now I'm bringing in 50 cents, but I'm 2 strikes wide. So I've got 150 is my risk, $150, and 200 is the difference between my strikes. It's still 75%. So I'll price out the difference there between 10 contracts of the 1 wide or 5 contracts of the 2 wide, which is still, your profit and your risk should all be very, very similar. And so you might go 3 wide, you might go 4 wide, but I would say in most cases, what you want to do first is you obviously want to price out the amount of risk that you're comfortable putting on. And then from there, it's all a transaction cost game, because putting on 10 contracts, if you charge per contract, it's going to cost you more than it would putting on 5 that are 2 wide or 3 that are 3 wide. So essentially, the width of your spread, in my opinion, should always just be dictated by the market, if it's tight enough to go wide enough and save money on transaction costs. Because the risk that you're putting in that trade, you should always have predefined. So whether you do 10 or whether you do 5, whether you do 3, that's all dependent on, essentially, basically what the risk is in that market, how close you are, and then from there, you're being cognizant of transaction costs. Does that make sense, Gary?
It does. So what you're saying is, if I did this 5 wide one, it's paying $3.72 on a $5 spread.
Mm-hmm.
So it's basically somewhere between. Is what you're saying that it's almost it's a little less than 80%?
Well, no, it's actually the opposite. So you're getting about, let's call it 370, right? You're getting 370 as your credit, and so you're $5 wide. So you want to subtract 370 from $5. So you've essentially got $1.30 of risk on.
Gotcha.
Right? And you would divide $1.30 by 5. It's basically 130 by 500, and that's your percentage of success there, of expiring above your break even. So you can see that one has a little bit lower probability of success, just because the strike that you're selling is so far deep in the money.
That makes a lot of sense. Okay.
Mm-hmm. Mm-hmm.
I've just looked at the graph on TOS of those, and it looks like the reward is greater, that you're leaving it more room to run. But I understand what you're saying.
Yep. No. I completely understand what I think the mentality of where you're going there. But I think, if you're trying to give yourself more room to run, and let's look at it again. In that case, you're putting up $1.30. And the expectation is essentially that you'll expire somewhere above, let's call it $30. I think in that case, on the opposite end of that, you could simply buy the vertical spread, on the opposite side, and you'd be putting up less capital, and you'd actually, have pretty similar break evens with higher, basically, profitability. So I think selling that spread, or selling that 33 strike so deep in the money, you kind of have to be careful, especially in something like this where the expectation is only, at the maximum, the expectation, the way the market has priced these spreads, they're expecting only a $2.26 move to one direction or the other. So that actually puts you really, really close to your break even. So you'd want to be careful about doing something like that. You're not necessarily getting the reward for the risk that you're taking on.
No, that makes a lot of sense. I'm not an option trader, and I've just been listening to your program for a couple of weeks now. And as I looked at them, I was trying to make sense of it, but that makes an enormous amount of sense.
Well, good. I'm really glad. I think the idea behind everything that we talk about here, Gary, is, if I was bullish in SLV, let's just say, because I think I see where the mentality is here, right around this 28 level has been a little, basically a level of support in silver. You also see a little bit of a break in the dollar here, a move in gold and silver today. It could be an interesting move as it basically came off the $26 level, and now it's back above its 28 support level. So I think I get the underlying premise here, but the way that we always tend to talk about utilizing options, especially on this program, is, well, the underlying here is trading at $28.63. And if I wanted to go bullish, how could I go bullish in a way that I could be wrong and still make money? And I think that's the underlying premise of everything that you'll hear, at least from a lot of the strategies that we'll talk about here. So it's trading at 28.63. If you were to sell the 28 put, which is trading about 70 cents, and buy the 27 behind it, and again, just as you mentioned before, you can get more aggressive and go 2 wide, 3 wide, whatever you want. And let's just do that for a quick example. So we could sell the 28, buy the 26 behind it. We'll bring in about 48 cents, depending on how we work for execution. And in doing so, we're taking on, or we're giving ourselves about a 72% chance of success on the upside. So what that means is we sold the 28, but we took in 50 cents. So our break even now is $27.50. That's a full $1.13 lower than where SLV is today. So that means if SLV stays where it is from now until December expiration, or 17 days into the future, we'll make the full 50 cents on every one spread we sell. If it increases in value, we'll make the full 50 cents on every one spread we sell. And even if it comes off, let's say just under 5%, maybe 4% or 3%, we'll still be able to keep that credit because it didn't come below our break even at $27.50. So the idea and the use cases and how we're using options are not to be highly speculative, but they're actually to exercise some sentiment in a way that we can be right and make money, and also be wrong to a low extent and still have the opportunity to make money or bring in income. So I appreciate the question, Gary. We're going to go ahead and wrap up here, and I appreciate the call. It's a great one.
Okay, thank you.
Take care.
Bye.
So again, in conclusion here, the markets broke just a little bit here. We're trading 1271 in the S&P 500 at 1850. The Dow 12,325 up 176 points. The VIX 2309, a little bit of an increase here, and obviously as the market sells off just a little bit, the VIX is coming back up, now down 31 cents on the day. Crude 1600 up $33, relatively stable, and that was gold, and crude 102.54 up 371, relatively stable as well. I want to thank you for listening to the last hour of the Options Hour on TFNN. My name is Victor Jones. Next week you will have a new guest. I'll be out in New York, actually. Chris Bolson will be on, so we'll look forward to it. Hope everyone had a happy New Year, and we'll see you next week. Thanks, everyone.